Today we have Professor Joshua Abor, who is actually sitting very far away from London, is in Ghana Business School. So yeah, I did some homework because it's quite a lot of things to introduce Joshua. I have some working experience with Joshua as well recently, and have some. I got to know Joshua a little bit better than last year, let's say. But I saw the email that I got a lot of new information about Joshua. Joshua, first of all, is everything. He's a professor in financial economics, is a qualified accountant, and also a professor in Ghana Business School. And he is involved in a lot of other organizations, banks, government organizations, as an advisor or consultant, etc. And he is a former dean of Ghana Business School, and he's also an adjunct professor of development finance at the Stellenbosch Business School in South Africa. And what else? He's also connected, associated with University of Business and Integrated Development Studies, Ghana. And he's also our friend. He has been an external fellow of our center since a long time ago. And thank you very much, Joshua, for your contribution and support to our center. And his research, if you look at the subjects that he has covered, I can just use one word to summarize everything. So he covered everything in terms of his research. His, particularly in financial economics, corporate finance, and fintech, a lot of different things, financial inclusion. So you can, for people who are interested in his publication, you can go to the website to look at the particular things. But I want to emphasize one thing that I'm so impressed by Joshua. Joshua has been producing a lot of books. So the most recent book, actually, I just saw a very nice book cover from LinkedIn a couple of days ago. And the new book, the most recent book, is called Monetary Economics in Emerging and Developing Countries. And that looks really, really good. So I congratulated Joshua in LinkedIn. And I know that Joshua is working on a very big, even bigger handbook that is Routledge Handbook of Infrastructure Finance, a Global Perspective, which I am also involved. I really look forward to that handbook coming out, and I think it's a very big research output. For people who are interested in knowing more, you can just read the book titles that we had in that email. I counted the number. I think it's more than a dozen. So I am really, very, very impressive, Joshua. And you work very hard, because I told you last time I saw you, when I email you, you immediately, respond. So that means that you are at the desk all the time. So thank you very much. So thanks, Joshua, for your contribution to us for today's seminar. And the topic is absolutely relevant. And for a lot of people, colleagues here, monetary policy, particularly in relation to shocks. And we had a lot of shocks. We had COVID, we had a financial crisis. And in the country I live, in the UK, every budget, caused the volatility of the government bond market, and that is very much connected to the monetary policy. So I can understand you are going to link monetary policy to foreign capital inflow and also domestic private capital. So I think without further ado, I would like to give you the floor, Joshua, and I'm sure we will have a very productive discussion. Joshua, are you ready?
Yes, thank you very much. Thank you, Hong, for the kind words and for the opportunity to share our research paper with colleagues, and thanks to the center as well. So this is a paper I'm doing with a colleague, Daniel Ofori-Sasu. He is on the call, so he will be involved in addressing comments and questions from the floor. So just quickly, by way of outline, we'll just look at the motivation, literature review, the methods we employed, empirical results, and then we'll try to draw some conclusions. So basically what we are interested in doing in this paper is to try and understand how monetary policy responds to shocks from private capital flows and the macroeconomy. But as a baseline, we established the relationship between monetary policy and private capital flows. How does monetary policy explain or attract, or if you like, private capital flows? So we can go to our next slide. So quickly, by way of motivation, we try to understand how monetary policy responds to shocks emanating from private capital flows and macroeconomic. And we see that there's limited work in the context of emerging markets and developing economies. And we know that though private capital flows or capital flows generally can be very beneficial, volatile private capital flows can result in some policy challenges, especially when there is a capital flowing and portfolio reversals and so on and so forth. That, of course, creates challenges for policymakers. We also know that emerging markets, emerging and developing countries have tried to employ different policy responses in an attempt to address such concerns. However, there remain adverse spillover effects of excessive private capital flows, and this has been established in the literature by a number of authors. Now, quite recently, we can move to the next slide. Quite recently, we've seen that with slowing private capital flows, emerging markets and developing countries have been very much concerned about the, if you like, adverse impact of monetary policy. And quite a number of studies have tried to focus on how private capital flows are affected, okay, when monetary authorities decide to move away unexpectedly from their core functions. We think that with the limited studies in this area, it's very important to appreciate how monetary policy responds to shocks from private capital flows and the macroeconomy. Now, if we take the work of Kadari et al. In 2010, we can move to the next slide. We note that an initial increase in private capital flows may decrease policy rate in the short run. But in the long run, central banks try to respond to upward trend in private capital flows by hiking their policy rate, or if you like, tightening their monetary policy stance generally. And of course, also changes in macroeconomic conditions or macroeconomic factors may have implications for the monetary policy. But this is an area that we haven't really seen much empirical work in establishing that relationship, how monetary policy responds to macroeconomic shocks. Okay, we can move to the next. So in this study, what we are interested in doing is to examine the extent to which monetary policy responds to private capital flows and macroeconomic shocks. Specifically, we first of all examine the effect of monetary policy on private capital flow. So would monetary policy encourage or discourage private capital flows? Then secondly, we try to understand the impulse response of monetary policy to private capital flows and macroeconomic shocks. And the third thing we try to do is to examine the effect of private capital flows and macroeconomic factors on monetary policy across different crisis periods, specifically looking at period of crisis and period without crisis. So let's quickly look at the literature, what the external literature says. First of all, in terms of the relationship between monetary policy and private capital flows. So prior studies have actually established this, that monetary policy significantly affects private capital flows, in the sense that once you hike, for instance, the policy rate, foreign investors, foreign direct investment or portfolio investors may want to invest in such an economy, especially portfolio investors, because of the favorable interest rate within the domestic economy. So we'll see that portfolio investors moving in, getting more foreign currency into the local economy. And this helps in stabilizing the exchange rate and, of course, curbing inflationary pressures, because once you strengthen or you stabilize the exchange rate, or be able to beef up the value of the domestic currency, that can help in containing inflationary pressures. Okay, we can move to the next. Okay, so we also know that the central banks often adjust interest rates and, of course, other monetary policy measures as a way of managing capital flows and thereby stabilizing the general economy. But such measures can also result in mixed results, can actually lead to mixed results, in the sense that if you have, for instance, changing or reversing policy stance by monetary authorities, that can lead to portfolio reversals, okay, and that may not be favorable to the domestic economy. So even though, yes, hiking the policy rate will attract private capital flows, especially portfolio flows, once you reverse the policy stance, that can lead to portfolio reversals. All right, we can go to the next. So now, unexpected volatility in monetary policy certainly can heighten capital movement, and this can lead to exchange rate or instability in the exchange rate, and therefore impacting on the macroeconomy or impacting on growth unfavorably. We know that in the case of emerging and developing countries, there's often vulnerability because of fluctuations in exchange rate, and that can dampen growth prospects and so on and so forth. And this is an area that we think a lot more empirical work is required, because we haven't seen much studies in this respect. All right, so we can now look at the literature explaining monetary policy response to private capital flows and macroeconomic shocks. We can go to the next slide. So private capital flows and macroeconomic shocks have some level of implication, of course, for monetary policy, and that can influence the formulation and effectiveness of same. So if you have movement in private capital flows, okay, whether in the form of FDI, portfolio flows, other financial transactions, this can impact on a country's economic stability, and that may require policy to respond in that manner. Now, if we're on to the next slide. So if we look at conventional monetary policy, we know that this can help to stabilize private capital flows, especially in the short run. But in the long run, the effectiveness is often constrained by the broader macroeconomy and other external factors or external pressures. Now, if you take macroeconomic shocks such as financial crisis, commodity prices, shocks coming from commodity prices, macroeconomic instability, these changes or these shocks coming from the macroeconomy will require monetary authorities to take appropriate monetary policy action, and therefore monetary policy will have to respond to these shocks. Of course, monetary authorities will always have to balance the competing demands of managing capital flows, managing external shocks, and also maintaining some sense of stability within the macroeconomy, the domestic macroeconomy. So balancing all these can be quite challenging, and we think that it's an area that requires proper empirical investigation. So quickly, in terms of our methodology, our data source, we relied on Global Financial Development Database, World Development Indicators, the IFS of the IMF. Our data set spans the period 2004 and 2022 over 138 emerging and developing countries. So we employ dynamic panel estimations. So first of all, in terms of the relationship between monetary policy and private capital flows, so we try to understand what monetary policy attract or discourage private capital flow. Of course, the hypothesis or the empirical intuition is that monetary policy will attract, or tight monetary policy will attract private capital flows. A tight monetary policy in the form of hiking the policy rate will attract private capital flows. So we use dynamic system GMM, and we see that private capital flows a function of past private capital flows, monetary policy, and other standard control variables. Now, in the second instance, we look at monetary policy response to the shocks in private capital flows. So this will be in our next slide. Okay, so monetary policy response to shocks in private capital flows and macroeconomic factors. So we rely on panel VAR and panel ARDL model. So here we are looking at how monetary policy will respond or is responding to, of course, we know that will be a function of the prior monetary policy, and then the shocks from private capital flows, and then monetary policy, and of course, we control for standard variables that may also impact of monetary policy. So in terms of variable definitions, that will be in our next slide. We define private capital flows, looking at the component, FDI flows, and then portfolio investment. Okay. Strictly in terms of definition, you may include debt flows, but we're focusing on, please go back to the previous slide. So focusing on these two. So FDI is defined as the ratio of net inflows of FDI to GDP. And then portfolio investment flows is the log of net inflows from financial securities, and the securities may be debt securities or equity securities. All right, so we can go to the next slide then. And then, of course, monetary policy, which we define as an interest rate that is set by the central bank. And then we have macroeconomic factors, as in economic growth is defined as GDP per capita growth. Inflation is used CPI. Real interest rate measured as the rate that will prevail in the market when the price of goods and services are constant, and then real exchange rates, also the exchange rate that will prevail in the market at constant prices of $1 relative to domestic currency. So quickly, in terms of our results, so because the tables are so long, I couldn't project these, but I have the first table that looks at the relationship between monetary policy and private capital flows. And we see from the results table here that monetary policy, yes, positively or significantly have a positive relationship with private capital flows, both in terms of FDI and portfolio investment. We can go to the next. So we also look at the impulse response, monetary policy response to private capital flows, just using these graphs. So we see that giving a one standard deviation shock to FDI flows, monetary policy increases significantly, and then it begins to show a steep downward trend in response to a positive FDI inflow shock, also in the short run. And then gradually we see that there's a steady rise in the trend in the long run. Now, the next slide also shows a one standard deviation shock in portfolio, reducing the impulse of monetary policy in the short run. But this begins to increase monetary policy response in the long run. And then thirdly, we see the impulse response, and that will be on the next slide, the impulse response of monetary policy to macroeconomic shocks. And we see that monetary policy responds to shocks in GDP per capita growth, and then interest rate, inflation, also minimizing in the short run, but increasing in the long run, while in the case of exchange rates, the impulse response of monetary policy increases actually in the short run, but reduces in the long run. Now, the next table looks at the impact of private capital flows, macroeconomic, on monetary policy. Okay, so we see that both in the long run and in the short run. Now, we established that monetary policy has a direct effect, or a direct positive effect on private capital flows, and that is pretty clear. And we explained that tight monetary policy stance, of course, attracts private capital flows. Meng, you can move to the next slide. So from the impulse response function, monetary policy responds to shocks in private capital flows, increasing sharply in the short run, but its response begins to decline in the long run. Now, if we go to the next slide, we'll see that FDI reduces monetary policy during crisis, but increases monetary policy during periods without crisis. And that seems to suggest that most economies will experience negative spillover effects during crisis periods, which tend to induce a negative effect of FDI on monetary policy. But during periods of crisis, we know that monetary authorities will hike policy rates with increase in FDI in the long run, while reducing policy rate during periods without crisis. Again, changes in FDI flows will have an adverse effect on monetary policy in the short run, but this tends to positive in the long run. Again, we argue that frequent changes in FDI will minimize policy rate, while will have a profound impact during periods without crisis. Now, in terms of portfolio flows on the next slide, we see that having a negative effect on monetary policy during crisis periods, but this tends to positive during periods without crisis. And again, portfolio flows will have a negative effect on monetary policy in the short run, but this tends to positive in the long run. Now, in terms of GDP growth as a measure of economic growth on the next slide, we see that having a positive effect on monetary policy in both periods. Now, with respect to inflation and exchange rate, we note that inflation minimizes monetary policy, but exchange rates rather increases monetary policy in both crisis and non-crisis periods. Now, in terms of real interest rate, we know that an increase in real interest rates reflects an increase in the level of monetary policy during periods without crisis. So we've established that monetary policy has a significantly positive effect on private capital flows, and therefore tightening a policy stance may encourage, especially hiking policy rate will attract private capital flows. Please, we can move to the next slide. I think we've talked about growth and inflation. So again, in terms of growth, we believe that central banks respond to an increase in the level of GDP growth by hiking policy rate to attract private capital flows in both the short and long run. Of course, when the macroeconomics is favorable, then it's very likely that monetary authorities will hike the policy rate to attract more private capital flows. Now, in terms of inflation, we said that that has a positive effect on monetary policy in the short run, while it has a negative effect in the long run. But we see that if prices are to rise faster than their target, then of course we'll see monetary authorities tightening their policy stance by, of course, hiking the policy rate in the short run. All right. So now in terms of interest rates, of course, generally, high interest rates, if you like, will attract private capital flows because what then will happen is that will discourage consumption, will discourage investment. That has a way of curtailing inflation. But an important point is that it can attract private capital flows. We've also seen how exchange rates can relate to policy, monetary policy response, and we said that this can be positive in both the short and the long run. And therefore, monetary authorities will tighten their policy stance in order to stabilize the exchange rate regime in both short and the long run. So if we raise policy rate, or if we increase policy rates, on the next slide, if we increase policy rates, then of course we are able to attract private capital flows. And we know that private capital flows may cause central bankers to reduce the policy rate in the short run, but in the long run, of course, they have to tighten in order to attract foreign currency to stabilize the exchange rate, and that will have an effect on stabilizing the macroeconomic generally. So, as an economy experiences larger capital inflows, central bankers will respond by setting a lower policy rate in the short run, but they will hike their policy stance in the long run. And we conclude again by arguing that this study on the next slide has provided evidence that private capital flows and changes in macroeconomic factors have a relatively stronger impact on monetary policy during periods of crisis compared with periods without crisis. And therefore, monetary policy interventions are extremely important in averting possible shocks that without, if you like, creating destabilizing capital flows in emerging and developing economies. So we end our presentation here, and we are open to questions. Thank you very much.
Okay, thank you, Joshua, for your presentation. I think it's quite concise, and so you mentioned the theory, underlying theories, and empirical research methods, empirical analysis results, and policy implications. I think the topic is quite. I think it's a conventional, macroeconomic topic, and I'm sure we will have some discussions, even from the very basic economics, and then we can talk about what the complicated factors that we observe in the practice. So, so I can open the floor to my colleagues here, to all the colleagues here. So, do I have any questions from the floor? Yes. Hi, Jaideep. Thank you, Jaideep.
Thanks. Hi, Joshua. Thanks for your presentation. I just wanted to sort of get an understanding of, the fact is that these kinds of things, especially in the economies that you're covering, they're clearly not linear, right? So there's lots and lots of threshold effects. So I was just wondering whether this is kind of the best way to test your hypothesis to begin with. And where, there's so many papers have been written about the different types of threshold effects. There were controversies around them. So I'm just wondering whether, you want to formulate hypotheses in this way. And that's my real main question.
Joshua?
Do I respond, or I take a couple?
You can respond.
Well, yes, I think that's a very good comment. No, we didn't consider threshold effect, but I think it's something that could be considered, especially in trying to understand the relationship between monetary policy and private capital flows. Is it linear? Does it mean that forever hiking or tightening policy stance can attract or will attract private capital flows, or there's a point, there's a threshold where or beyond that private capital flows begins to decline. So it's a very useful question which will reflect and rise in the paper. Yeah.
Okay, thank you very much, Joshua. Thanks for both the question and answers. I saw Kieran. Kieran, hi. Please come in. Yeah, thank you.
Hi, yes. Thanks very much for the paper. I was very interested in it. I have a couple of questions about the data first. Are all of the variables that you've used stationary, because that might affect the regressions that you used, and also the definition of the variables. So you have foreign direct investment, as I understand it, calculated as a ratio to GDP, and you have portfolio flows defined as a log variable. So I'm wondering why that was the case. But those are just minor points on the data. And my more substantive point is about what you've done, really. So it was quite fast. I was trying to follow what was the definition of monetary policy. I think, if I understood you to say, it was actually the bank rate was used as a proxy for monetary policy, but you can correct me later on if I haven't understood that. But anyway, I think of monetary policy as a broad regime rather than a particular movement in a particular variable. So, for example, monetary policy might be aimed at inflation targeting. And there will be, for example, in South Africa, there are periods of time when inflation targeting was adopted by the central bank and other times when inflation targeting wasn't adopted. So monetary policy will reflect all of that in a broader way than a particular variable. And I think that possibly connects to some of your estimation work, because if the central bank is known to have an objective function, which is, of course, different across countries, so that makes a difficulty with having a large number of countries in your panel. But if they have a particular objective function, then those objective functions will perhaps be known by foreign investors. So when you refer to unexpected monetary policy, I'm not sure what that means. It could mean a shock to monetary policy, or it could mean an unexpected shock to monetary policy, because a shock to monetary policy might very well be understood by foreign investors if they are following the objective function of the central bank that is trying to gain credibility by having a regime in which it is more or less transparent as to what they are doing. So in terms of the long run and the short run, that might be important. So my understanding is that you think of the short run as one where the central bank is where the investors are responding to the immediate shock, and then later on that gets reversed. I think because of volatility is your argument, because of the threat of volatility. But of course, that threat of volatility might not be there if the objective function is understood by the investors. So I don't have much else to say, but I suppose it's related to that in a way. I was a bit surprised by the finding that central banks tend to tighten monetary policy in a high exchange rate regime. I would think under some circumstances, a high exchange rate regime would be dampening inflationary pressures, and therefore not lead to either short run or long run hikes in interest rates. But perhaps I misunderstood something there. Thanks very much anyway for an interesting paper.
All right. Okay. So thank you very much. I'll invite my colleague to come in. But quickly, in terms of the definition of monetary policy, it's consistent with what previous studies have used, and normally is because of difficulties in getting a variable that is universal. Normally, countries adopting inflation targeting will use the policy rate as their anchor. So we're thinking that there will be a good measure of monetary policy stance as opposed to the others, which may not even be available in terms of data. Now, with respect to the definitions, yes, so FDI is quite consistent with the literature. Private capital flows, yes, some studies have used log of investment in securities, but we could also consider investment in securities scaled by GDP. But a log is also something that have been used in other studies. Yeah, we'll take note of the other points that have been made. We'll reflect on them, see how we can incorporate them in revising the paper. But Daniel, if there's something you want to add.
Okay. Thank you so much. Okay, I understand that we need to consider the objective function of the central bank as to whether we are considering inflation targeting. I think this is something we may want to consider going forward, so that at least we can find out within a particular regime, what the objective of that particular country is really considered. So going forward, I think in our study we want to incorporate into our model the objective function of the central bank, so to have a robust and then rigorous analysis that can be mirrored in other jurisdictions as well in the emerging market perspective. So that is by way of letting us know that going forward, we may also want to consider that as well.
Thank you very much, Karen. And do you have any more, or you think? Karen, are you okay with the? Do you want to respond anymore? Okay. Thank you very much, Karen. Thanks. We have some other hands. I saw Martin. Martin, welcome. Hi.
Thank you. Can you hear me?
Yes, I can hear you. We can hear you.
Okay, can I follow up on that discussion about the objective function of the central bank? Because it's quite often the case that central banks also have an objective of dampening volatility in the exchange rate. And in some cases, they may even have a long-run target for the exchange rate for competitiveness reasons. And in view of that, often they respond to private capital shocks, to inflow shocks, whether positive or negative, by intervening in the foreign exchange market, by buying or selling foreign exchange. For example, if a lot of private capital and puts upward pressure on the exchange rate, they will purchase the dollars from the market. And that may or may not be sterilized by the central bank, and therefore may or may not have an impact on the interest rate. So I think it will be worth. Now, I can appreciate that data on central bank intervention is not always transparent in the way that interest rates are. So it's not easy to incorporate, but I think it'd be worth trying to do that if you can find some data on sterilization in response to private capital flow shocks. Thank you.
So it's a comment, right?
Yeah. Suggestion.
Yeah. Okay. Do you?
Just well noted. Just well noted.
Well taken. Yeah, thank you. So yes, let's Bo, you welcome and good to see you again. Yeah.
Yeah. Yeah, Ghana has a troubled history of IMF bailouts. They have tried to do inflation targeting, but not been very successful. So I think you need to take more account of the actual de facto monetary policy in Ghana a bit more and see how that works. It might be also that IMF bailouts have sometimes taken time to solve, and that could create also some problems in the data, perhaps. Maybe a political risk premium occurs here and there. The other thing is that there's also a lot of discussion about the US monetary policy, how that affects other countries. So we know it does affect other developed countries with, say, good financial markets and such things, but they also affect developing countries and emerging markets to various extent. So it's the foreign factors here, and then the response during COVID and other times when you have extremely low interest rate in the US for a while and spread across the world. That is another factor. So somehow, the rest of the world, the world interest rate or the US interest rate might be a factor to consider. Then as mentioned also, these are non-stationary variables, and that could cause problems for you. But it is a very interesting effect to see what happens with private capital flows in this situation, because they could ease monetary policy, of course, in the right circumstances. And if you understand this better than this mechanism, then the Central Bank of Ghana would, of course, be quite happy, because it would help them to improve their monetary policy. So it is a very interesting topic you have here. So that's all I have to say.
Okay, thank you very much. So do you have anything to respond to both the comments? Oh, yeah, I guess it's comments.
It's a suggestion which we would take on board. But let me mention that, interestingly, yes, even though we haven't made, when I say we, I mean Ghana, much progress in terms of using inflation targeting, but relatively, compared with a controlled regime, we've seen inflation relatively lower during this period of inflation targeting compared with when we're using monetary targeting and the control regime.
Yeah, so thank you very much. I think I have some questions that I didn't start because I know we have a lot of macroeconomists here. So I'm thinking about two things. One is your title, the paper is on your sample countries are all emerging and developing countries. And what you have done actually in the paper is what I say, conventional monetary policy stuff, macroeconomics. And those are probably more applicable to the US, the advanced monetary policy system. So my first question is, given that you work on a sample of emerging and developing countries, what are the differences? So that is related to the contribution of your paper as well. So I remember I studied all those, the basic things, when I did my master at LSE. So I can recall something, although, but now I think things are quite different, right? And we have, so think about the monetary transmission mechanism or channels. And I think we have two different sets of transmission channels. They are not necessarily the old stuff that we learned. So that's one thing. Think about China. China is using quite different things, and in terms of how to transfer the monetary policy into the reality, into the corporate sector, to attract the foreign capital, for et cetera, et cetera. But that I'm talking about the emerging market in general now. So that's my first question. My second question is actually, I'm thinking, do those countries really use monetary policy to attract the foreign capitals? I do not think so, because I'm not so convinced, because think about the geopolitics now. So think about when you may want to invest in somewhere, and what are the most important factors now as compared to what we were told from the textbook. So how do you think about those type of complications? So we observed in the reality. So we see the foreign direct investment moved into different areas that cannot be explained by the conventional theory. So that's my two concerns, and I want to dig a little bit deeper, because I think I want to see the contribution of this piece of work.
Well, I mean, these are very useful points. So on the transmission mechanism, I think it's very important, because one will want to understand what is unique about emerging markets and developing economies, so that we are not just replicating a study similar to what is done in advanced economies. So probably beyond maybe doing some stylized practice, it will be also important to try and compare our results with other results of from developed markets. If it means even including the data in our analysis, that may also help. And then also identifying what is unique about emerging and developing countries in terms of transmission mechanism, and how we can incorporate this in our model. Now, the question you ask about whether monetary policy really attracts private capital flows. So I wouldn't say that for FDI, because FDI is more long-term, and there's capital coming in where you have equity control, and normally it's more than 10% of equity investment, and then you tend to have managerial control. But that's more long-term. But in terms of portfolio investment, yes, monetary authorities or monetary policy committees take such decisions, especially during unstable exchange rates. And back in Ghana on the MPC, we've taken decisions like that when we are experiencing exchange rate or depreciation in the local currency. We try to hike the policy rate just to attract portfolio investment. The challenge with that is that it's always short-lived, and whenever you're able to deal with inflation, you begin to drop the policy rate, then you see portfolio reversals, and the currency also begins to get hit. So that's a challenge. But in the immediate term, you're able to attract portfolio investment to just stabilize the value of the local currency. Yeah.
Okay, so thank you very much. And any more questions or comments? No? Okay, so I think we have done what we have for this one. And that obviously, I think the topic is so interesting, and it's so important. So I would like to thank Joshua for your presentation and your preparation. I know you're very busy, and for your calls as well, Daniel. So thank you. And for my colleagues who are here and sparing their time listening to this presentation, and thanks for the questions. So Joshua, do you have anything to say before I close?
Oh, just to say thank you very much for the opportunity to share our paper and to get such valuable, insightful comment. I want to thank all participants and the comment that came. We'll seriously factor this in revising the paper, and so we can get it into a very good outlet. Thank you very much for the opportunity.
Thank you. Okay, thank you, everybody. I'll see you, some of you next week.